Hi, this is Jim Bush here to do the Growth Trader Friday update for January 11th. Today, I'll be covering a few things. In addition to covering the two new editions that will appear on Monday's rankings. First off, what I'd like to do is basically, since we're just starting up earnings season, is just sort of walk you through a few examples of the types of opportunities I look for during earnings season. And generally, what this is it combines a company that has a sudden earnings catalyst, basically one of those big out of the blue sort of blowout quarters that no one saw coming, with a good looking chart that suggests that that's a name that had been under-owned prior to that quarter. So I'll just give you a few examples, so we'll jump right into it. The first one is a former emerging growth name. This is Stamps.com. This is a chart of Stamps.com prior to the July 2011 breakout. And right off the bat, they reported on the afternoon, during the afternoon, after hours session. I remember when the report came out, I hadn't looked at Stamps.com in years. And, the first word that came into my mind was just wow. It was one of those quarters where, a name that, you knew about it, but, they'd never really done anything. The stock's never moved. There's never been any reason to look at it. Reported just a tremendous quarter and gave guidance suggesting that there was more to come. And then, when you look at the chart, which is what I'm showing you right now, basically what you can see is that this stock had been trading sideways for 9 months. Where I drew the arrows here, those are the earnings reports that occurred during this consolidation. Couldn't get any traction off those earnings reports. In fact, if you look at a longer term chart, the stock has basically been moving sideways for several years. So really, you can look at this chart and think that this is probably under-owned, just given the name itself, and look at this sort of choppy sideways movement. There definitely weren't expectations into the quarter that this was going to be such a big quarter. And so what happened after those numbers came out, this is sort of the before and after chart. This is also a daily chart. As you can see with this gap here, that's the post-earnings gap. The report was good enough that basically it gapped the stock up well above that long-term consolidation phase that I had just shown you before. So not only do you have a real fundamental catalyst in earnings that caught everyone by surprise, but also now you have a technical catalyst as well. And that's a really powerful combination. Stamp went on to run about 250% after that. So there's one example of the type of setup. Just a real kind of sideways, sort of nothing chart, and then a big report that really sort of blows away expectations, where the expectations were kind of low in the first place, but it was a really powerful report. Another one I'll show you, this is another emerging growth name. This was SolarWinds. This is actually a weekly chart going all the way back to its IPO in 2009. Basically, SolarWinds had been moving sideways for about 3 years before their big earnings report. And it was a similar situation. You can look at, even though this is a weekly chart, you can even see in the more recent trading action in 2011, the first 9 months or so of 2011, you can see the stock basically went nowhere. And in the larger context, really it was going nowhere, but it was kind of bumping up against this post-IPO resistance zone. So, again, it probably was a name that few people were watching or expecting much of when they reported in October of 2011. And based on at least the past, the year prior to that, you could probably look at that and say this was fairly under-owned, at least among technology funds. But then when they reported that quarter in October 2011, it was what it did after that. It's a similar situation. They reported just a blowout quarter that really just basically put the stock on the map. What it probably did was, after that quarter, a lot of funds probably looked at this name really for the first time and basically decided that, those earnings were powerful enough, we need to own this name. So Combination big fundamental catalyst with the earnings report and big technical catalyst because it basically moved it, you can't see it on this weekly chart, but it actually gapped it above that 3-year consolidation pattern. So again, very powerful combination there. Now, one thing is that you can't really screen for these types of names beforehand. And the reason is because, first of all, the quarters were really nothing to speak of beforehand. So you can't really screen it on the fundamentals. Generally speaking, the technicals aren't that great. They've kind of been chopping sideways for 6 months to several years. But what you really just do is have to pay attention during earnings season. When you see these huge beats by names you either have never seen before, or you know about them but you never thought much of them, pull up the chart and take a look and see whether this earnings report might be powerful enough to gap it above a really key resistance zone, such as with stamps or with SolarWinds. One name, just to give you an example of one that I is kind of keeping on my radar going forward in this respect, it actually has a very similar chart to SolarWinds, is another software name that I've actually highlighted on the service before. This is Pros Holdings, and this is actually close to a 5-year chart ever since their IPO in 2007. It's not quite as tight as SolarWinds, but this is another one where it's a technology name. They put together some decent quarters, but nothing that spectacular. But it's sort of coming up the right side of the chart and starting to consistently bump up against that resistance zone between 18 and 20. So this will be a name, as long as it kind of keeps sort of hovering in the high teens. This is a name that every earnings season I'm going to be watching to see if they can finally report that big quarter that'll gap it above 20. If they do, this is the type of sort of long-term chart setup where you could see theoretically a double or a triple out of it. So this is just one example of a name that I'm sort of watching these, each earnings report for kind of a similar move. But it may happen or it may never happen. That's the thing with these. So basically, my advice is just pay attention. Every day during earnings season. Easiest thing to do is just check the gapping up lists in the morning during pre-market. And when you see a big percentage move, check out the earnings report on our earnings calendar to see whether they had a big beat. If you have a big beat, big gap up, see if it's gapping above sort of a long-term resistance zone. And those could be some really powerful ideas. So that covers that. That's my typical strategy during earnings season. Those are opportunities I really like to watch for. What I'll do now is move on to the new additions to Emerging Growth on Monday. There are 2 of them. The first one this is a name that Emerging Growth readers may already be familiar with since it's been on our list before. On assignment, ASGN. This is a professional staffing firm. It's like Manpower. These staffing firms, as you might imagine, are highly cyclical. They tend to have thin margins. So during certain points of the cycle, they can work really well, but otherwise, they're not stocks that trend particularly well, sort of over time. But ASGN is interesting because they're actually a really high quality name. They're actually one that we like a lot here. Basically, they're a smaller staffing firm. Historically, they'd been really strong in the healthcare vertical, but they made a big acquisition in March 2012 that basically doubled the size of the company and expanded them into the IT vertical. And it was just a real complementary acquisition. Turned out to be very accretive, and ASGN has sort of been doing this stair-step move higher ever since. It looks like it gapped up on January 2nd, a couple weeks ago. Just with the broad market, we can't find any specific catalyst as of right now. So it's definitely very extended right now, there's no question. But on a pullback, this could be sort of a cyclical IT-related name that could work out really well. So that's the first one. This is a name we really like. The second one is one we don't like that much. VOXX. People who've been trading for a long time may recognize this one. This stock has sort of been a dog for more than 10 years, probably 12, and they sell electronic products for car and home use. It's been a turnaround story for as long as I can remember. Quarterly results have always been very erratic. One quarter might give people hope the turnaround is finally gaining traction, and then the next quarter will kind of dash those hopes. So this is a tough one to really like. They've been shifting their mix, their product mix, from sort of the low end towards the higher margin home and car products, smartphone related accessories, high end audio systems, that sort of thing. So they're kind of doing the right things. They're focused on profitability, getting margins higher, but this the onus is definitely on AudioVox to prove to investors that that there's something to like here. So I'll just leave it at that. We'll see. You look at the chart. There's actually pretty clear lines here of support and resistance bounded by that July gap. So if it gets above 950, maybe you can conclude that this is something worth looking at, just in terms of just stocks getting enough accumulation to move it above that level. But we'll see how this one goes. So that's it. Like I said, we're just starting earnings season. Should be a lot of good ideas coming out of this earnings season, I hope. And if I see any that really grab my attention, I'll be posting them throughout the week on the live in-play page. And have a great weekend, everyone, and I'll be back again next week. Thank you.